Hey everyone, welcome back to Corporate Decoder. This year Angi is ditching IAC, but is this a clean break or is there still baggage from their parent company days? Let's decode this filing and find out. Get ready for a deep dive into Angi's 2025 annual report. We'll uncover the raw numbers behind their breakup with IAC, what risks they're facing, and whether their business is truly on solid ground. If you love getting the real story behind corporate moves, make sure you are subscribed and join our Discord community linked in the description below for more exclusive insights. Alright, let's jump right into the financials. Angi Inc. reported total revenue of just over $1 billion for 2025. Now that might sound like a lot, but it is actually down about 13% from the previous year. That is a pretty significant drop, and it means they are bringing in roughly $155 million less than they did in 2024. Breaking that down, the US segment, which is their biggest chunk of business, saw a 14% drop in revenue. That is a $152 million decrease. Their primary revenue source, leads, which are basically connections between customers and pros, took a small hit of around 3%. However, their advertising revenue took a massive dive of 31%, and services revenue also dropped by 23%. This suggests a real struggle in attracting and retaining advertising and service clients. One of the most striking figures here is the network revenue, which plummeted by a staggering 72%. This is a massive number, essentially meaning they lost over 2/3 of the money they made from connecting customers to pros through third-party websites. This seems to be a strategic decision they made in early 2025 to give homeowners more choice, but the financial impact is undeniable. Now let's talk about profitability. Their total segment adjusted EBITDA, which is a measure of their operating performance, came in at $140 million. While this sounds positive, it is actually down by about 4% from 2024. The US segment saw a 13% decrease in this adjusted profit, while international operations showed strong growth of 71%, which is great news for them, but it doesn't fully offset the decline in their core US business. Angi holds a significant amount of goodwill on its books, over $890 million. This goodwill is essentially the extra value the company paid for acquisitions over the fair value of their net assets. They reassessed this goodwill and their intangible assets for impairment, and thankfully found no major issues. This means that the value they paid for past acquisitions is still considered valid, but it is always worth watching these large goodwill numbers. Depreciation expense dropped by a huge 47%, which sounds good, but it is mainly because they significantly reduced their capitalized software spending. This could signal a slowdown in investing in new technology or a shift in how they account for it. They also reported a $12.8 million restructuring charge. This means they've been cutting costs and likely laying off employees to streamline operations. In late 2025, they announced further workforce reductions impacting around 350 employees. This is a clear sign they are focused on improving efficiency and cutting overhead. Let's look at their cash position. Angi ended 2025 with over $303 million in cash and cash equivalents. That is down from over $416 million at the end of 2024. While they still have a healthy amount of cash, the decrease combined with the lower revenue suggests they are using cash to manage operations and potentially stock buybacks. Speaking of stock buybacks, Angi repurchased over 10 million shares of its class, a common stock, in 2025. That is a significant buyback program costing nearly $150 million. This can be a good sign if the stock is undervalued, but it also uses up cash that could be invested elsewhere. Now onto the risks. Angi operates in a highly competitive and fragmented market. They are constantly battling with search engines and online directories. Their success heavily relies on consumers continuing to shift to online platforms for home services, which is not guaranteed. Marketing costs are also a huge concern. They spend a lot on digital and traditional ads, and there is no guarantee these efforts will be cost effective. Changes in search engine algorithms or policies from giants like Google could severely impact their traffic. Cybersecurity is a major headache for Angi. They face constant threats and have experienced past security incidents. A breach could damage their systems, their reputation, and lead to significant fines and lawsuits. They also have to trust their third-party providers, which adds another layer of risk. Their debt situation needs a closer look. Angi has $500 million in senior notes. While they have a revolving credit facility in place, they had no outstanding borrowings as of the end of 2025. The covenants on their debt could restrict their ability to make business decisions. A huge event for Angi in 2025 was its spin-off from IAC. The filing explains that on the 31st of March, IAC completed the separation. This move was meant to give Angi more financial flexibility and allow it to pursue its own optimal capital structure. However, the report warns that the expected benefits may not be fully realized and that the spin Off could be subject to tax implications. This separation is a major strategic shift, and its long-term success is still to be determined. We saw that Angi has substantial goodwill from past acquisitions. Auditing this goodwill was challenging due to the complex judgments and estimates involved. The fair value of their US reporting unit exceeded its carrying value by over $100 million and the international unit by over $240 million at the end of 2025. This indicates that while the goodwill is substantial, it seems to be holding its value for now. A critical aspect of their operations involves highly automated systems for processing US-lead revenue. This involves a significant volume of low-dollar transactions, and auditing it required a deep dive into their IT systems. They've implemented controls to ensure accuracy and completeness of transaction data, which is crucial for reliable financial reporting. Angi's stock-based compensation is quite complex, involving restricted stock units, market-based awards, and performance-based awards. In 2025, they recognized about $14.8 million in stock-based compensation expense. This is significantly down from almost $35 million in 2024. This decrease is partly due to a reversal of previously recognized expense related to a former CEO forfeiting shares. This is a complex area that directly impacts shareholder value through dilution. Looking at the revenue breakdown again, the US lead revenue, which is their bread and butter, showed a 17% increase in proprietary channels. This is a positive sign that despite overall revenue declines, their direct consumer engagement strategies are showing some success. So what is the big picture here? Angi is clearly undergoing a major shift after its spin-off from IAC. While their US revenue and profitability are down, the significant drop in network revenue and the substantial stock buybacks suggest a company in transition. They are heavily investing in their proprietary channels and cutting costs through restructuring. Risks remain high with intense competition, evolving consumer behavior, and cybersecurity threats. The success of their new strategy post-spin-off will be crucial. The numbers suggest they are betting on more direct consumer engagement and efficiency gains to drive future growth. What do you think about Angi's strategy and their financial health moving forward? Let me know your thoughts in the comments below. If you found this analysis valuable, please hit that like button and subscribe for more deep dives into corporate filings. And don't forget to join our Discord community linked in the description for more exclusive content and discussions. Thanks for watching. See you next time on Corporate Decoder.